The price of gold just had a massive breakout from its 4 month long consolidation period, marking a major turning point in the macroeconomic economy that we haven't really seen since 2007. Now, this is mainly due to the combination of inflation expectations rising, which we can see right here with the 5 year break even inflation rate, and the Cleveland Fed's inflation nowcast for August and September showing that inflation is going to remain unchanged or slightly higher, while at the same time, the market is expecting the Fed to cut by 25 basis points, as shown by the futures market expectations, the CME Fed Watch tool, showing that there's a 95% chance that they're going to cut by 25 basis points. And this is also shown by the 13-week Treasury bill dropping to 40 recently. Now we can see this a little bit more clearly when comparing the yield curve from 6 months ago in green versus the current yield curve in blue here. And so the long end of the curve, as we know, is the bond market's expectations of future growth and inflation. And then we have the short end of the yield curve, which is the bond market's expectation of Fed policy, whether they're going to cut or raise interest rates. And so as you can see over the past 6 months, we've had a steepening of the yield curve from the short end dropping based off of Fed rate cut expectations, as well as the long end rising because of inflation expectations rising, as well as we're having a large debt problem in the United States right now. Assets that could keep performing well in this environment are precious metals like gold, silver, and platinum. You also have select sectors like materials, energy sector stocks, as well as select financial sectors, as well as, of course, you have short duration bonds. Now, of course, the only thing out of this environment is either a soft landing or a hard landing. A soft landing, you would really need to see growth to have a huge comeback here, as well as inflation start to cool. And then a hard landing, which is most likely the probable outcome based off of history, that is when we go into a full-blown recession, and that is when the Fed starts to emergency cut rates, as we see the long end of the curve start to actually fall. So far in the year of 2025, gold has outcompeted the stock market by more than 3 to 1. And over the past 12 months, gold has more than doubled the performance of the stock market. Our team's model has been bullish on gold for the past couple years, but it most recently signaled on August 21st to add more aggressively before this large 7% run up. If you missed out on this move in gold here, don't worry, there are other bullish assets that are out there that are gearing up to do something potentially similar to this, but the main thing is to not stay stagnant. Make sure that you are spotting these opportunities so that you can make sure that you are compounding your wealth and not letting inflation eat it away. Now, if you want some help with that, just DM me the word macro, and I will send you a link for a 7-day free trial of our macro investing community so that you no longer miss out. What do you think is going to get us out of this clearly stagflationary macro environment? Let me know in the comments below, and I will catch you in the next video.